This was last week when I wasn't here. Wise had their earnings come out as ever. I mean, I'll bury the lead here, Steve. They're good. I was quite impressed with pretty much everything on it. The market seems to have not really loved them that much. It's still flat year to date now. Wise, it's about down around 1%, but actually down about 8.5% in the last 5 days. The market's souring on probably a couple of things as well, but we'll get onto them. So. And with Wise, they like to report non-underlying and underlying earnings just to try and give you an idea of how the business is actually doing, because the actual revenue isn't actually the revenue and things like that. So they're trying to give you the best overview of the company, and we'll try and explain that as we go on. But if we just want to go on non-underlying for now. Revenue 1.2 billion, up 15%. Gross profit that came in, Steve, at 1.3 billion, which is kind of unbelievable when you think about it. That's up 20%. That's a gross profit margin of 108%, and net income of 417 million. That's up 18%, a margin of 34%. So I hope you're beginning to see why the non-underlying earnings are not particularly useful to you. Let's just rattle through these underlying ones and they'll maybe help you out a little bit. So fee revenue, 1.2 billion, up 15%. International income, 150 million, up 25%. Interest income, 150 million, up 25%. And that income, the total amount was 1.6 billion, up 16%. Underlying income, 1.4 billion, up 16%. Gross profit, actually a billion, up 20%, margin of 75%. PBT, which is profit before tax, 282 million, up 17%, about a 21% margin. Very good. Net income was about 417 million, up 18%, a 31% margin. They generated about 333 million in free cash flow. That was up 35%, margin of 24%. And card revenue came in at 220 million. That was up 31%. And other revenue, 152 million, up 71%. If we look at business metrics, active customers. Active customers was 15.6 million. That was up 21%. And that's broken down into personal, 14.9 million, up 22%. Business, 697,000, up 11%. Cross-border volume came in at 145 billion. That was up 23%. 106 billion personal, up 22%. 39 billion business, up 24%. So growing very well. In terms of customer balances, 17.1 billion, that was up 29%, 10.5 billion in personal, up 33%, 6.6 billion in business, up 22%. And in terms of underlying income, 1.4 billion, up 16%, as we've discussed earlier. Personal made up 1 billion of that, at about 18%. Business made about 322 million of it, up 12%. In terms of assets under custody, that was 4.5 billion, up 52%. Customer holdings came in total of 21.5 billion, up 33%. So I thought those numbers across the board, Steve, are pretty good. I don't really think there's anything in there that's particularly jumping out at me. In the call, essentially there was only 3 or 4 real items that really wanted to bring to your attention here, but they basically said that Wise has experienced significant growth and expansion in the past year. It's strengthened its position in the global payments market, and in terms of their achievements, they said that essentially global expansion and infrastructure was one of the main achievements. They've expanded direct payments integrations into Philippines. It's their 6th direct connection. They also, just to clarify that, sometimes they have to go through banks and brokers to get a connection because they can't directly connect to the monetary system in that country. Other times they can directly connect to the monetary system in that country. So when they say direct connection, that's when they've connected directly into a monetary system in the country rather than using the bank or broker. But yes, they've also gained access to Japan's Zengen and Brazil's Pix instant payment systems, which enhances their global reach. They've launched services for Mexican and Filipino customers. They've brought Wise Business to Hong Kong and Brazil. The cross-border payments infrastructure now boasts about 70 licenses and 90 integrations with domestic banks, including 8 direct connections, and solidifying their competitive advantage. They also said that they've improved service offerings. Steve, this is something that we talk about every time we talk about Wise, but instant transfers, which they classify as something that's completed in under 20 seconds, increased from 49% to 65%, which demonstrates that they're constantly improving efficiency for customers. They've also continued to roll out its assets features, allowing customers to earn returns on their balances, which is now live in 30 countries. So they said that they've got some pretty large strategic partnerships. So they've grown presence with Morgan Stanley, with Nubank, with Itaú Unibanco, which is Italy's biggest bank, and now Standard Chartered. Despite this growth, they said that their take rate decreased from 0.67 to 0.53. And this is kind of two things, really, showcasing their commitment to providing a cost-effective service, but also the fact that there's a tiered rate on these really large businesses. So the more and more that you stick through it, the cheaper it is for you. But yes, they've been doing a bit of cost optimization, and you couple that with a bit of increased scale, record high revenues, record high profit before tax. It's committed to this long-term, medium-term guidance now of about 15 to 20% underlying income growth and about 13 to 16 sort of profit before tax. So they're just basically trying to say this is a sustainable model that balances profitability with price reduction for customers and continues to become more efficient for them, which I think I would say tick, tick, tick when I read for that, Steve. The other thing that came out with this announcement, or shortly afterwards, was that they are moving to the American markets. And not just as a dual listing or not just as a secondary listing. The primary listing is moving to America. They will be retaining a second listing in the UK, but it's I would expect the liquidity to move off elsewhere. And we did kind of say this might happen, Steve. I think it's a 10 billion quid company. And I think it deserves better than that, Steve, to be honest with you. And we've just not given it that here. So when you do that to your good company, Steve, they go looking elsewhere. Plus, the UK's rules around, admitting this company into the FTSE 100 or the FTSE 250 or wherever they want to put it are archaic. They're not fit for purpose anymore. And basically, Wise isn't allowed to do this. And if they were admitted into the FTSE 100, I think they have a 3-year, or is it either 3 or 4 or 5-year timeline that they have to change the business to meet those rules, and they have no intention of doing so, Steve. So rather than change the rules, we just bollocksed it and lost another company. How do you feel?
We've wondered for a little while now. I think every time we've talked about this company, we've said, imagine what it would be like if it traded in the US. Well, here we go. We will see. And the short answer is it would be more expensive because the thing went up on this news. It's gone down since then again, actually. But stock pushed quite significantly higher on the news it was moving to the US. Actually, that day, I think about 3 companies said they were off to the States, including Wise, in the space of a day. Headlines, I think justifiably, that the London markets have a problem here. Note, of course, that Shein is now not listing in the UK, despite us being willing to overlook the various kind of ethical issues that there might be about it. That's going to Hong Kong. And now we're into the stage, as far as I can tell, in terms of the UK markets of, well, everybody's blaming everybody else. The regulation people are saying, well, it's not a regulation thing. It's to do with like liquidity and stuff. There might be some truth to that, but that doesn't fill me with optimism that the idea that this is going to get better anytime soon. It just kind of fills me with, I don't know, a sense of resignation that we're just going to hear people blaming everybody else about what the problem is. And, well, the problem is manifold, as we kind of all already know here, Steve. So let's get back to, let's get back to Wise in a moment. But here's a sort of, it wasn't an official prediction or anything like that, but a suggestion I had put to me by one of my fellow bull writer colleagues as to what goes next, basically, to the States. And he had an idea that I'll just state here. So this is from Ben McPoland, if he's right, and from nobody at all, if he's wrong. The next kind of cab off the rank could well be Experian, was his idea. It's basically a US business, does nearly all its business out there, reports in dollars because it's so US heavy here. The only thing I think holding them in the UK at the moment, because this would actually make a lot of sense if it went off to the US for not just a multiples reason, is it does actually trade at quite a high multiple in the UK. This isn't an obviously discounted thing that I can see where it's clearly being kind of underpriced. I actually think it's pretty expensive where it is at the moment, and it does a reasonable job of standing out against a fairly ungrowthy, more cyclical crowd. But to my mind, it actually makes a lot of sense that Experian might go off to the States, and that might be one of the next things to go. The AJ Bell Money and Markets podcast always does a decent job of trying to pretend like this is somehow not a thing and going away. I don't know why, to be honest. I like their podcast quite a bit. But they always keep saying, wow, it's not really the case that this moving to the States thing works. Yes, it does. And it's not really a bad thing for London. It made lots of sense for this company to go over there. No, it didn't. And this is, to my mind, a kind of needless denial of this straightforward reality that we face ourselves with here, which is that UK markets need to get more competitive. But let's actually talk about Wise for a bit, shall we? Because they are very competitive, and it's the kind of stock I think that not just the UK, so leave aside the fact it trades in the UK, but it's very easy for investors to get this wrong if they're not looking carefully enough at the underlying business model. Because normally what you would like to see from a kind of investment perspective, if you're thinking about growth stocks, which this is realistically a growth stock, is operational leverage. So as revenues go up, margins get wider because your costs are largely fixed. So your incremental revenue, dollars, nearly all dollars these days in growth stocks, fall straight through to the bottom line, and your earnings go up by the same amount in dollar terms, but that means they go up faster because there were some costs in there, so adding another $5 to your revenue line and adding $5 to your earnings line is a bigger percentage increase on earnings. And for Wise, it's exactly the other way up. They have 21% more customers, so that makes 23% more cross-border volumes and 29% more balances. Good-o. And that means 15% more in terms of revenues. Less good-o. And then it means a kind of more modest boost towards profits, and you think less good-o. But the point with Wise here is that that's largely attributable to that take rate being 14 points lower. And a lower take rate means, well, actually what they do is they get more customers in, have bigger balances, more cross-border volume, and just charge them less. So they keep growing, and they end up charging people less and less and less, and use that money to increase their licenses, increase their integrations, widen their moat. All of a sudden, they are quicker and faster and cheaper. And what was the other thing? More reliable than any other provider, and they are just putting distance into themselves in the field. If they want to in the future, they can ramp things higher. Maybe they do, maybe they don't, but that's a long way off for the time being. They are just pulling further and further away from the competition in what is a regulated industry that's difficult to get into. They're in a different part of this market to Adyen that we've talked about before, where Adyen goes after kind of big corporate institutional thingies. Wise is much more kind of focused on ordinary people sending money around, from what I can see of it, at least at the personal level. That's the kind of key with this sort of business. It's it's a kind of everyday low prices of generate massive scale, use your economies of scale to charge less than everybody else, and then reinvest back into low prices. It's a Costco type of model in a certain way, or an Amazon type of model. It's not exactly the same as either Costco or Amazon, because I'm not sure they have quite the same sort of membership thingy going on here. But there is a bit that comes from kind of siphoning off balances here, and they talk about that first 1% as being their kind of core or underlying. I've said before, and I still think that's quite a conservative idea, that they think rates will kind of at least fix out at 1%. I think they'll stay higher than that for a bit, so I think they will be better than 1%. But even that was up 29% or so, that first 1% of interest they're getting on customer balances. And this is, I think, the more this goes on, the more I like it, to be honest. And the more I see the take rate coming down, the more I kind of like it. You wouldn't normally enjoy seeing this in kind of your traditional, conventional growth stock type thing, looking for nice operational leverage all the way down. And I think that's why people get this wrong quite a bit. I'm not saying that's the reason the UK has got it wrong in general, but it doesn't surprise me in the same way when this thing puts out a strong report and goes down. I kind of shovel this under, well, that's the market thinking about it one way, and I tend to think about it a different one. Steve?
Yeah, I pretty much agree with you there, Steve. Steve, completely. I think Yeah, I remember. I remember when I was trying to find it. Then I was just having a bit of a Google around. Now, I felt certain transfer wise was a crowd cube or a Seeders company at one point that was raising money, but I can't find any information on that. Although I'm fairly certain it's right. And I remember watching the video on it, and it was basically somebody talking to Christo Klarman, and they said to him, what kind of how low can the prices go for FX? Where would you like to see them? And he looked straight in the camera and goes, zero. And you're like, well, you're like, oh, you think you're trying to get some money off people here, mate? You've got to charge them for something. Do you know what I mean? But I actually think he's kind of dead serious about getting it down to zero, because I think he figures that if he has just that much money held in the platform, the kind of FX transferring around could be done for nothing, and he'll just skim off some money out of the balances to make his money, and obviously have things like cards and do interchange and things like that. So, yeah, he's I mean he's pushing hard on that goal to get this to zero. But yeah, it's doing really well, Stephen. And like I say, I'm really happy with it. It's in the Brit box. It's I think it's one of our double positions as well. So obviously, we're both really happy with it. And yeah, I'm intrigued to see how it does moving on to the American market, because I thought this was something that it was probably going to have to do at some point to get some respect, and it's going to do that now. So I'll be watching to see if this backfires or not, Steve. But yeah, I think, and look, for me, it's a strange move. When we were talking about Experian, um, yes, makes a lot of its money in America, and the same with Ashtead Technology. Not only does Ashtead Technology make the Ashtead Group, sorry, make the vast majority of its money from America. It's even headquartered in America, so that makes perfect sense for it to be in there. Why is it not really the same story? It's a it's definitely not. I wouldn't say a UK UK only business. It's a kind of global business, but it doesn't make a lot of money from America. It's not headquartered in America. It doesn't really have any business being there, but we'll see if they can. Well, the Chinese companies listed on there, and they had no intention of being here, so we'll see if Wise can fool them as well, Steve.
Yeah, Ashley Technology, I think, makes most of its money beneath the sea, from what I can tell of it. But I suppose it's got to float on something. So, anyway, should we punch on to the next thing after that horrible finish to the what was otherwise quite an interesting company?
Let's go for it, Steve, before we sink.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.